Mark Harrell. He is the president and CEO of CNB Bank. Mark, good morning. Thanks for coming in.
Good morning, gentlemen. It's great to be to join this brain trust of spring and weather. So,
Do you have any flower advice to offer?
I would have outpunted my coverage if I had joined that conversation. So.
Yeah, well, we did too, so we're all in the same boat on that one. Mark, lots going on in the financial world. We have the Fed and interest rates and the direction of the economy as to whether we'll have cuts, hold the same, or maybe even an increase, although I'm not hearing a whole lot of talk about that anymore. We've got changes at the federal government level, some of which may or may not affect banking in one way or another. And one of those is the Consumer Financial Protection Board. There's been a lot of publicity about this group and what appears to be a total dismantling of it. And if you don't know any better, you probably think that that group's been around since banking's been around, but really it's a fairly recent addition after the banking crisis from about 15 years ago. Let's talk a little bit about what they do, what they did, and how it affected banks positively or negatively as a person in banking. Mark.
Oh, sure. Thank you very much, Rob. Really appreciate the opportunity to come in and join this group. You started the conversation about interest rates, and for the last several months to 6 months probably, I've been feeling very optimistic. I think stable is good when we consider interest rates, whether they're moving up or down. Create some instability. And to my view, it looks like we're in a stable market right now. And so I think if things settle down, once we get past this political vortex that we're currently find ourselves in, but feel pretty good about the overall economy. With respect to the CFPB, and look, we're all consumers, right? We should all be concerned about any time the government's talking about dismantling, in your words, Rob, an agency that's really tasked with protecting consumers. And as a community bank and a banker, and I'll kind of enter a selfless plug here, community bankers, that's what we're built on, right? We're built on a mission to take care of our clients. We play, work, and our kids go to school in these areas, and we worship in these areas. So protecting consumers at the heart of what we do. So we have strong alignment with what the CFPB was really tasked to do. But let's talk a little bit about history, if you will, about kind of how we ended up with the CFPB and kind of dig into that a little bit. So again, the CFPB was established to protect consumers really in unfair practices, right? And so they enforce consumer laws, educate consumers, and that's important, and kind of a central repository for fielding complaints. And this was really born out of the housing crisis in the late 2000s. And if you see what happened with the housing crisis, let's start with greed, right? Everybody can agree there was a whole lot of greed that was happening in the housing crisis, and there's no shortage of blame. But if you really kind of go back and peel that onion back a little bit further and look at what really kind of contributed to that greed and kind of set the infrastructure in place, you really had to kind of go back to Fannie Mae and Freddie Mac. And Fannie and Freddie have been around for a long, long time. They were propped up back during the Great Depression era, and really were established to help home ownership, right? And so that has worked for decades. So the question is, or the right question should be, what happened in 2000 that created this crisis for the housing community, right? Because it just didn't happen overnight. And so if you kind of go back and look at the history, a couple of things, and this is a really complex issue, so I apologize in advance. We could spend hours on this. So complex that Michael Lewis, a fantastic business author, wrote a book called The Big Short on this, and subsequent to that, there was a movie that was released.
Great movie.
Great movie. And when I read the book, and we made it required reading for our board, you had to have a dictionary, well, back then a dictionary fired up, or Google, to be able to work your way through. He's such a talented author. It's a great movie, and it captured it really well with the financial markets. Where we may have been able to do a little bit more justice is talk about the history, what led us to that environment. And if you go back to the efforts under the Clinton administration, which for really, really good reason, were promoting home ownership. And so in 1995, they launched an effort, and really it was a combination of trying to pull private and public sector together to drive home ownership, and it was the National Partners of Home Ownership. And if you and President Clinton had all the right ideas. If that were released today, I think all of us would go behind and support it. And they had an ambitious goal to raise home ownership from what was then 64% to 70% by the end of the decade. And so from 1995 to 2000, some 8 million additional homeowners coming on the roster. So all great. Everyone would embrace that. At the same time, capital requirements were being adjusted for investment into what you recall Michael Lewis wrote about, the mortgage-backed securities, the credit default swaps, allowing banks and investment banks to invest more heavily in these. So parallel to what the Clinton administration was doing for all the right reasons to improve home ownership levels, capital requirements were being loosened. And so when you combine those two things, you create an environment where Lehman Brothers, Goldman Sachs, and others, while they may have had a small part of the revenue coming from that type of investment, it was becoming 80, 90% of the revenue. You know what that does? Triggers greed. And they had to feed the beast. And so that's what kind of started this whole process. So looking at the history of what put us to the spot of needing a CFPB, and there's some debate whether or not we already had some of those things covered, really have to understand the history of that.
Mm-hmm. And that takes us to the modern day when it has basically been dismantled. So let's talk about the effects of the dismantling of the CFPB.
Before we do that,
yeah,
what was the mission of the CFPB?
So the primary mission of the CFPB was to protect consumers from financial harm.
How?
Well, through laws, through policy, through education, through a repository for complaints. Now, John, it's a great question because the next question should be, well, wasn't the FDIC already doing that? Wasn't the OCC, the Federal Trade Commission, about a dozen regulatory authorities were already doing those things? And leading up to the 90s, by all accounts, we're doing a pretty effective job at it.
Yeah, and that was actually my next question for you was with the dismantling of the CFPB, were there already breaks in place in the system to make sure that consumers were protected? And with it being dismantled, what systems are in place to do the same work? Yeah,
absolutely, Rob. Thank you for that. And those systems have been in place for a long, long time. Mm-hmm. And in the financial services industry, we are among the most heavily regulated industries, and for good reason, right? We've got information. We have access to our customers' most precious information, and we facilitate financial transactions every day. So we should be highly regulated, and we should be held accountable. We are subjected to internal auditors who are reviewing, among other things, our policies and procedures. We are subjected to external independent auditors who also review our policies and our procedures. And being a state charter bank, we are regulated by the state through the Division of Financial Institution as well as the FDIC. And not only do they go through a review of safety and soundness, because we're in the risk business, right? So they're mm-hmm. reviewing us for how we're monitoring our risk and managing our risk, but also consumer compliance. And so making sure that we are following the letter of the law, that we are disclosing things appropriately, and equally important, what we are disclosing, we are actually executing appropriately.
Mark,
that's been a long-standing set of policies.
Sorry, what's the redundancy between these various agencies?
There definitely are redundancies, Bill, and let me back up a little bit. The CFPB has supervisory responsibility for banks over 10 billion. Okay, so now some of the rules that they will propagate, they will have a trickle-down effect to community banks. But if you put together the three community banks here locally, I think if you aggregate our assets, we wouldn't even be a quarter of the size, so we still wouldn't qualify to be covered under the supervisory guidelines of the CFPB. And so, I'm sorry, Bill, repeat your question.
No, the question was, and you've answered part of it, is the redundancy.
The redundancy,
of the CFPB rules and regulations and guidance as opposed to the other groups.
Right, and so you're exactly right. That is the duplicate mission is some of the critics that will put forward that we were already subjected to guidelines under the FDIC. We're held accountable to those. And you know what happens when you have multiple agencies who are reviewing your work, you have conflicts. And, we would see firsthand complaints from both sides. From the FDIC would complain about the OCC, who complains about the CFPB, because they're kind of sometimes on different set of rails.
So, so there's the question of redundancy. There was a 60-minute segment a couple of weeks ago that announced, if you're not already know about it, the elimination of CFPB. And 2 points were being made. One, that it was literally closed down overnight. The people walked in, thought they could get access to the desk the next day. They could not get in the door. They were escorted in to pick up their belongings from the desk. And the abruptness of closing it down is one question. What shockwaves did that put through the system? The other thing that 60 Minutes raised was the records, CFPB records, was being accessed by again, I'm quoting 60 Minutes, by a small group of young folks that did not have auditing background. They did not have experience in this particular area, but they had access to all the financial records. From a banking community, and again, you were not under the CFPB because of the size, but the abruptness of closing down, coupled with the fact of loss of the or access to the records, were those either one a cause for alarm?
Yeah, it sure is disruptive. And to go further, Bill, to that point is how effectively did they vet these folks who have access to these records? And that's yet to be determined. Exactly what records do they have access to? It's not clear to me. I watched that 2 different times. I kind of played it back and it just wasn't clear to me what records they have. They talked about trade secrets for some of the larger banks, some of the algorithms they use with AI. That was all kind of new to me. Some of the things that our customers from time to time will raise is my personal information compromised? From that perspective, I'm very confident. We haven't changed anything the way in which we do things. We hold information confidential. We don't release any of that information. To the extent the CFPB or any government agency, for that matter, has that is beyond my skill set to understand.
So there's a good chance that personal information was not made available to these individuals going in and looking at CFPB records.
Bill, I think the way I don't think so. I think the way I would answer that is just from my experience for more than 3 decades and working with those who audit us and examine us. They're coming in relying on our systems. If they are going as granular as customer information, they're relying on our systems to do that. I wouldn't be aware of an agency or how that information would be domiciled on their records.
I want to go back to the actual mission of the CFPB. Excuse me. I am on AmericanProgress.org. It says, since opening its doors 12 years ago, the CFPB has been a formidable advocate for everyday Americans, holding financial institutions accountable for predatory practices and returning $17.5 billion to wronged customers across the 50 states. What kind of things, why would a customer call the CFPB, and then what would happen?
Yeah, John, from my understanding, reading some similar things out on the internet, is it would appear that the majority of their complaints they filled are about credit card fees and payday lenders. I'm not familiar with payday lending in that industry, but there's a lot of criticism around that.
If you're a sailor, you would recognize it.
Whenever examples are cited where a payday lender charges a fee that I think the 4 of us would agree is just astronomical, It is, however, serves a need in the market. And by the records of the CFPB, basically they shut down about 80% of those transactions. So where are those consumers left to fill those transactions? Whether or not we like the fees, that's another topic, but it did fill a need in the community.
Were they legal?
Well, fair question. They're not governed by the same. So they're trying. So what the CFPB was trying to put forward was these are considered loans, and should follow all the same guidelines that a bank would follow. But if you apply that, your APR, your annual percentage yield, would be multiple hundreds of percent.
Yeah, John, I don't know if they're legal or not, but they're everywhere around military bases.
They're everywhere around Woodbridge, Virginia. I mean, it's wherever you've got. There are places people go for credit that I would never consider going, but then I'm not everybody. Pawn shops for me would fall into that same kind of category. But if it's not illegal, right, it's
they don't appear to be illegal because they are everywhere.
Right. So I guess by eliminating the CFPB, what category of protections are we actually taking away? Do you know?
Yeah, I mean, I don't. Again, John, I don't. As a community bank, we're not in that.
Right.
We're not in that space. I think for one of the things, and we hadn't touched on this one. Do I dare bring up the overdraft comment? And I think, and I was talking with Bill a little bit about the unintended consequences of some of these things. Whenever you shut down services or begin to put caps on services, that can have some unintended consequences to it. And the question I continue to raise to the industry is the CFPB was forcing the larger banks to cap overdrafts. They have three different choices in which they can exercise: a $5 cap, or produce evidence of whatever it does truly cost them, or make it a credit product. That all sounds good on the surface, but the question I have is what follows that in terms of gaining access for a lot of those clients, of how those banks will treat those clients prospectively when and if they have multiple overdrafts. The bank determines they can't generate enough revenue to offset that risk. Remember, I mentioned earlier, we're in the risk business. Mm-hmm. If they can't offset that risk and they stop providing those services to those clients, what happens then? The pawn shops, the payday lenders, mm-hmm. those types of things. So you have these, it's a complex issue, and I wouldn't begin to advocate on behalf of the large banks, but it's not as simple as just starting to put caps on fees.
Yeah, this started a lot of places, but we heard a lot about it in California Bank, 15 years or so ago. Whatever happened to that, Mark? The bank that was going bankrupt because it was overextended its credit. And
well, sure. I mean, one of the biggest risk, if not the biggest risk to a bank, is credit risk.
Yeah.
And we're constantly managing that, monitoring that, and candidly, that's when safety and soundness examiners come into your facility. That's what they're hyper focused on. What's kind of grown out of that is cybersecurity risk, other types of liquidity risk, sensitivity to interest rate moves, a lot of other risk kind of born out of that. But a big component is also compliance risk as well. And John, I don't know that I've answered your question completely because, again, I'm just not familiar with mm-hmm. that space. What I would say is, and I was mentioning this to our team, we aren't taking any kind of formal position on the CFPB. I think the basic mission of the CFPB was solid. We're all consumers, and we all want to have those protections in place. If you go back, if you allow me, and I mentioned earlier,
we have 3 minutes, Mark.
Oh my, the home ownership strategy, and this is Partners in the American Dream. This was born out of in May of 1995. I have a letter written from then President Bill Clinton. This past year, I directed HUD Secretary to work with leaders of the housing industry for nonprofit organizations with the leaders of every entry of government to develop a plan to boost home ownership in America. Right, and so, and then following that is a letter directly from the then housing secretary. The strategy was to prepare a response to request from President Clinton. So then there's this whole, I don't know how many pages there are because there aren't page numbers on here, but there are 8 different sections of this. And I think it's important for all of us to recognize the CFPB was born out of the housing crisis. Right? They were put together to deal with the housing crisis.
But it's only a 12-year-old agency.
Exactly. Yeah.
Right.
And that's why they were propped up. So there are 8 chapters to this document, and I'll just take you to, if you allow me, to the action number 44. The partnership should support efforts to increase local lender awareness and the use of flexible underwriting criteria established by the secondary market, FHA, and VA. It goes on to say liberalize affordable housing underwriting criteria and open the market to Fannie Mae and Freddie Mac. And then there was an excerpt in here talking about in Connecticut, the People's Bank kind of formed a partnership with Fannie Mae to help expand mortgage activity. And then similarly, Fannie Mae increasingly looked at compensating factors to traditional underwriting. So my point in sharing this was, this sounds an awful lot like what CFPB was doing. When you get into the components of this, talking about partnership structure, production, you're talking about financing, consumer protection, consumer education awareness. All of this was kind of the impetus that expanded the underwriting criteria, which really, look, I'm not suggesting for a second that greed didn't drive this, but this is really why the CFPB was created. And I think that's why the criticism exists out there for it.
Yeah, and ultimately, you can't lend money to people who don't have the ability to pay it back. And you especially can't lend too much money to people who can't afford to pay it back.
Correct. Yep.
And that was a lot of the housing crisis. Good stuff. Appreciate you coming in.
Thank you very much.
Thanks, Mark.
Appreciate the invitation.
Yeah, Mark Harrell from CNB Bank, President and CEO.